The cost of owning a home does not end with the mortgage. For many homeowners, another bill has become harder to ignore. Homeowners insurance. It is often paid through escrow or renewed once or twice a year. For a long time, many households treated it as a predictable part of homeownership. Across parts of the United States, that assumption is changing. In January 2025, the U.S. Treasury's Federal Insurance Office reported that homeowners insurance was becoming more costly and harder to obtain for millions of Americans in areas vulnerable to climate-related risks. The report used zip code level data from 2018 through 2022. It covered more than 330 insurers and about 50 million policies per year. That scale matters. This is not simply one household receiving one higher bill. It is a broad insurance market issue, measured across many companies, ZIP codes, and policies. For homeowners, the economic meaning is direct. Insurance is becoming another pressure point in the cost of housing. A household may budget for the mortgage, it may budget for property taxes, it may budget for repairs, but when insurance rises, the cost of keeping the home rises too. And in some areas, the issue is not only price, it is availability. Treasury described insurance as becoming harder to obtain in certain higher-risk areas. That can leave homeowners with fewer options, higher costs, or greater difficulty finding coverage that fits the household budget. The system behind this bill is the way insurers price risk. A homeowner's insurance premium is not just a fixed fee. It reflects expected losses, claim severity, rebuilding costs, disaster exposure, reinsurance costs, state regulation, and whether insurers are willing to keep writing policies in a specific market. When those pressures rise, the price of coverage can rise. When insurers see too much risk or too much cost, they may limit where they write new business. That is what happened in California with State Farm General Insurance Company. On May 26, 2023, State Farm General announced that it would stop accepting new California property-and-casualty applications, effective May 27, 2023. The company cited historic increases in construction costs outpacing inflation, rapidly growing catastrophe exposure, and a challenging reinsurance market. For homeowners, those terms translate into practical costs. Construction costs affect the price of rebuilding after damage. Catastrophe exposure affects the likelihood of major losses. Reinsurance affects what insurers pay to protect themselves from large claims. When those costs rise inside the insurance system, they can eventually reach the homeowner's bill. California later allowed State Farm General's interim homeowners rate increase of 17.0% to remain in place, with no additional impact beyond the approved interim rate. For affected policyholders, that is a direct increase in the cost of maintaining coverage. California is not the only place where pressure has appeared. In February 2026, the Government Accountability Office reported that average U.S. homeowners insurance premiums rose 3% after adjusting for inflation from 2019 to 2024. That national number can look modest, but it hides major regional differences. GAO found that in some southern coastal high-risk areas, premiums rose 25% or more after inflation adjustment. That difference is important. Homeowners do not pay a national average. They pay the premium tied to their state, county, ZIP code, home, and risk profile. For a homeowner in a lower-risk area, the increase may be manageable. For a homeowner in a high-risk coastal region, the increase may be much more serious. GAO also found that premiums as a share of 2023 median household income were highest in Florida, Louisiana, and Oklahoma. That links insurance directly to affordability. The question is not only how much the premium rises, It is how much of a household's income insurance absorbs. When that share grows, there is less room for the rest of the budget. Groceries, utilities, car payments, repairs, medical costs, credit card balances, retirement savings. That is why homeowners insurance has become part of the broader cost of living story. In May 2026, Pew Research Center reported that 71% of U.S. homeowners surveyed said their home insurance costs had gone up over the last few years. 42% said those costs had gone up a lot. That survey does not prove the exact cause of every premium increase. It does show how widely the issue is being felt. Pew also reported what homeowners believed was driving the increase. 65% cited insurer profit-seeking as a major reason. 61% cited repair or rebuilding costs. 46% cited extreme weather events. These are consumer perceptions, not a full actuarial breakdown. But they show how homeowners are trying to understand a bill that is becoming harder to absorb. The verified data points to several confirmed pressures. State Farm cited construction costs, catastrophe exposure, and reinsurance market conditions. Treasury cited climate-related event costs as a challenge for insurers and customers. GAO found that premiums vary by risk and geography, with some high-risk regions seeing much larger increases than the national average. At the same time, the available sources do not assign one single share of premium increases to climate risk, rebuilding costs, reinsurance, insurer margins, or state regulation. That distinction matters. The homeowner's insurance problem should not be reduced to one cause. It is a system of overlapping pressures. The cost to rebuild matters. The chance of loss matters. The cost of insurer protection matters. State rules matter. Insurer participation matters. For ordinary homeowners, the complexity of the system does not make the bill easier to pay. It means the bill comes from forces they do not control. A homeowner may not follow reinsurance markets. They may not read state rate filings. They may not study claims severity by zip code. But they know when the premium goes up. They know when the escrow payment changes. They know when insurance becomes a larger part of the cost of staying in the home. The pressure affects households differently. For homeowners on fixed incomes, a higher premium can force trade-offs. For families already managing mortgage costs, taxes, groceries, and utilities, insurance adds another layer. For homeowners in higher-risk zip codes, the concern can be both affordability and access. Can they get coverage? Can they keep coverage? Can they afford the coverage available? Availability can matter as much as price. An expensive policy is difficult. A shrinking market can be more complicated. When insurers reduce new business in a state or region, homeowners may have fewer choices. Fewer choices can make comparison shopping harder. It can also place more attention on state-regulated alternatives or insurer of last resort systems. The research does not provide one national answer for every homeowner. It shows an uneven map. Some regions are under greater pressure than others. Some states face more intense affordability challenges. Some homeowners are seeing larger increases than the national average suggests. That unevenness is central. Treasury's data covered more than 330 private insurers and about 50 million homeowners policies per year. GAO found national inflation-adjusted premiums rose 3% from 2019 to 2024. But some high-risk areas saw increases of 25% or more. Both can be true. The average can look moderate. The local experience can feel severe. For many households, homeownership was already expensive before insurance became a central concern. Housing costs include mortgage payments, taxes, maintenance, and repairs. Insurance adds another required cost. For homeowners with a mortgage, dropping coverage is usually not a simple option. That makes insurance different from many discretionary expenses. It is not entertainment. It is not travel. It is not a purchase that can always be postponed. It is part of owning and financing a home. That is why a rising insurance bill can quietly change the economics of home ownership. It can make a home more expensive to keep. It can make monthly payments less predictable. It can reduce the cash left after required bills are paid. And in higher risk areas, it can raise questions about whether the cost of ownership remains affordable for households that already stretch to buy. The company view, government view, regulatory view, and consumer view each show a different part of the issue. State Farm pointed to construction costs, catastrophe exposure, and reinsurance conditions. Treasury pointed to rising cost and declining availability in areas vulnerable to climate-related risks. GAO showed that premium increases are not evenly distributed. Pew showed that most homeowners surveyed said their costs had gone up. California regulators allowed State Farm General's interim 17.0% homeowners rate increase to remain in place. Together, these facts point to a market under pressure. They do not prove that every homeowner faces the same problem. They do not prove that one cause explains every increase. They do show that homeowners insurance has become a more important part of the affordability equation. For middle-class homeowners, the practical impact is clear. The insurance bill competes with the rest of the household budget. It can raise housing costs. It can reduce savings. It can make repairs harder to afford. It can add uncertainty to long-term planning. For retirees or fixed-income households, it may turn a once stable home expense into a recurring source of pressure. The current status is still unsettled. State Farm General's California interim homeowners rate increase remains at 17.0%. Nationally, verified sources show insurance pressure remains uneven by geography. Higher risk regions continue to face greater affordability and availability challenges. What remains uncertain is how premiums and availability will change in specific zip codes as disaster risk, rebuilding costs, reinsurance costs, and insurer participation continue to evolve. That uncertainty matters because homeowners need predictability. They need to know what it costs to stay in their homes. They need to know whether coverage will be available. They need to know whether the next renewal will fit within the budget. The home insurance bill is not always the most visible part of the cost of living problem. It does not change every week like gasoline. It does not appear in the shopping cart like groceries. But when it rises, it can reshape the cost of owning a home. For many Americans, the pressure arrives as a bill, a renewal notice, an escrow adjustment, a higher required payment tied to the place they already live. The verified data shows a clear pattern. Homeowners insurance has become more expensive and harder to obtain in higher risk areas. Some national averages hide sharper regional increases. Major insurers have adjusted their business in states like California. Regulators are responding to rate pressure. Homeowners are reporting that costs have gone up. What remains unresolved is how far the pressure spreads, how much it changes household budgets, and how different states manage the balance between insurer risk and homeowner affordability. For the homeowner, the issue is simpler. The mortgage may be fixed. The house may be the same. The income may not have changed. But the cost of protecting that home can still rise. And that quiet increase can become one of the most important bills in the household budget.